Now we will take a moment to introduce you to our speakers. Our speakers today are Dan Merritt and Paul Meany. Dan is a principal in Raymond's Public Sector Assurance Group and manages a wide range of assurance and consulting engagements. He works extensively with municipalities, counties, school districts, and special purpose governments. Paul is a senior manager in Raymond's Advisory and Tax Services Group. He is a research and development specialist with a focus on federal and state research tax credits and has an extensive expertise in performing R&D tax credit analysis for organizations of all sizes and in various industries. Dan, you may begin the presentation.
GASB 101 is the new standard on compensated absences. If you are a December 31st reporting entity, this standard is newly effective to you. Why a new standard on compensated absences? Well, the GASB felt it was time to revisit GASB 16. They felt that potentially there were issues of comparability among local governments, and also that having a new model would result in governments recognizing a liability that more appropriately reflects when an obligation is incurred. So more closely lines up with the definition in Governmental GAAP of what a liability really is. So what are the changes in the rules now? Well, under the previous rules, if you've been accounting under GASB 16 for years, you know that you accrue a compensated absence when it is eligible to be paid to an employee on termination of employment. You can see we're going to add another section of that rule here. The payment or settlement could occur during employment as well as on termination of employment. So what we're going to do today is we're going to talk through some of the definitions under the standard and then talk about when they might be applicable to accrue a liability and what some of the interesting situations are under GASB 101. So GASB 101 gives us a definition of what a compensated absence is, and that is generally something that doesn't have a set payment schedule, but might include vacation leave, sick leave, paid time off, holidays, parental leave, bereavement leave, and certain types of sabbatical leave. So a compensated absence could be a number of things. Not all of these things necessarily are something you accrue a liability for, but they're all different things that could represent a compensated absence we might have to consider. So the rules now for recognizing a liability under GASB 101, you have to meet three parts of this rule, and you have to meet all of them. First, the leave has to be attributed to services already rendered. Second, the leave has to accumulate. Third, the leave has to be more likely than not to be used for time off or otherwise paid in cash or settled through non-cash means. So that last bullet point, again, is where we're going to kind of start to really differ from GASB 16, because this is something that can not just be paid out to an employee on termination, but also something that might be used during their term of employment. And that is the main differentiation between GASB 16 and GASB 101. So as part of bullet C there, we note that it has to be more likely than not. So we made some type of a definition of what that means from the GASB to figure out, okay, I know this is some accounting gray area. We're doing an estimate. What is the more likely than not rule? Well, the GASB says it's greater than 50%. How do we determine if it's greater than 50%? The GASB gives us some suggestions. Could be, we could help ourselves determine that based on the government's employment policies related to compensated absences. We can look at bargaining unit agreements. We can look at the employee handbook. Really, any type of governing policy that would tell us how are employees eligible to use or be paid on those potential compensated absences. We can look at whether or not things have been earned or eligible for use for payment in the future. And I think maybe most importantly, we're going to look at historical information about the use, payment, or forfeiture of compensated absences. I think bullet C here is really where we're going to get into the weeds on GASB 101, and that's we're going to have to do an analysis. We're going to have to look back. We're going to have to get some data. We're going to have to say, what have we been doing thus far over the last several years? What does the data tell us about what portions of compensated absences have been used? What portions of compensated absences have been paid out? And we're going to have to do a calculation. We're going to have to do an estimate, some type of analysis to figure out whether something is more likely than not to be used. Luckily for us, the pay rate to use to measure the liability is not changing. We're still going to use the rate that is the employee's pay rate as of the date of the financial statements. This is the same under GASB 16 as it is under GASB 101. So we're not actually changing anything on the calculation from the perspective of what is the rate used to measure that liability. The GASB also gives us some specific rules and addresses a couple of common situations, such as what if that leave converts to a benefit for a DB plan? So if I am a finance director at a government and I can convert all of my sick time that I've been banking up or my vacation time, what have you, I've been banking this time up over a number of years that I've been employed, and I'm planning to convert that to a service credit at the end of my employment. I am not going to include that in my calculation of the liability for compensated absences. Why? Because GASB 68 and 75 tell us that those liabilities, your net pension, your net OPEB liability, should be a true capture of all future potential benefits for employees discounted back to today's rates. So the portion of what I am expecting to convert to a DB plan should be captured in the estimate by the actuary and not something that is accrued through the compensated absence liability. So what happens if we have some compensatory time for potential leave? This might be parental leave, maybe military leave, jury duty. Do I have to, as someone trying to accrue compensated absences, say to myself, well, I have 3 reservists on staff, and I think 2 of them might go on active duty next year, and so I'm going to accrue leave. You don't have to do that. For things that are dependent on the occurrence of a sporadic event, you recognize those as liabilities when that leave occurs, right? So let's say you're halfway through someone's military leave as of the financial statement date, you might accrue a liability for the remaining portion of that leave that is occurring, but you aren't going to try to guess at how many employees of mine will take jury duty or get called for jury duty next year, I should say, and try to add that to my compensated absence liability. The standard also tells us what to do about sabbatical leave. So if you're an institution of higher education, you probably have a number of employees that qualify for sabbatical leave. You say, is that part of compensated absences or not? Well, under the GASB standards, if you are required, if your employee or faculty is required to perform any significant duties, research, travel, something like that during that sabbatical leave, that is not a compensated absence because they're required to work during that leave. If there are no requirements, then the GASB basically says that is vacation time. Your faculty might feel differently about that, but the GASB says if there's no significant duties required during that absence, it is vacation time and should be treated as a compensated absence. What about situations where an organization might have unlimited leave or holidays set in advance? Well, I think of these two, governments probably have holidays, and very few situations I've run into where a government or a GASB reporting entity has an unlimited leave policy. If you had an unlimited leave policy, you would get to skip implementing 101 because there really isn't anything to accrue there. Employees take time as needed. There isn't something to be banked or accrued in advance. Holiday leave, most governments do have, but is also something that we exclude from our calculation of the compensated absence liability because that's taken on a specific date. It's not at the discretion of employees. In most situations, holiday leave is set at the beginning of the year by the calendar, for the administrative office. They say you're going to get Christmas, Christmas Eve, what have you, Thanksgiving as your specific holidays. They'll tell you in advance it's not at the discretion of employees, and therefore doesn't meet our rules for something that should be banked as a liability for compensated absences. This is going to have some impact on the financial statements, insofar as I think generally speaking, most organizations are going to see a net increase in the total liability that they have to accrue under GASB 101, because you have an additional piece, right? It's not just that which is paid out on termination, but it's also what an employee might be eligible to use during the year. But also, they're going to simplify the presentation and disclosure requirements for most organizations. And that will mean that you don't have to try to figure out what are adds and deletes in your long-term debt schedule. You're just going to show a net increase or a net decrease for the liability for compensated absences as part of that schedule. So a little bit of simplification there. How are we supposed to implement this standard in our financial statements? Well, if you think back to previous presentations or previous GASB standards, GASB 100 tells us that a new standard is accounted for as a change in accounting principle. That means that we're going to restate all prior periods presented if practicable. We're going to go back to the earliest period presented, and we're going to have to display the nature of the change, financial statement line items, and identify the pronouncement implemented. So basically, we have to implement it as of the beginning of the fiscal year, or if we're presenting comparative financials, the beginning of the earliest period presented on the face statements. And we're going to have to ask ourselves, okay, what is the effect from the beginning through now? If it's material, if there's a material effect on beginning that position or beginning fund balance, we may have to consider restating, adding a footnote, etc. So when we think about the application of this principle, it's not just changing the year-end balance, it's changing the entire period presented, starting with the beginning balance. So just a couple of things I want to think about from a practical perspective, and a few takeaways here. There could be a number of possible options for calculating under this standard. I know Raymond has an implementation team that is working with clients on the standard and is available to you if you're interested. And we've developed our own version of a template for calculating compensated absences under GASB 101, but it may be, depending on your own internal bargaining rules, that the calculation doesn't actually change that much. So you want to think about all the possibilities for calculating under this standard. Look for an approach that's efficient. And remember that if you have a smaller population, you just might have less substantial adjustments, right? And most counties, we're going to have large populations. If you're maybe a road commission or a school district that has a smaller employee base or less bargaining units, this might be a little bit more simple to implement than otherwise it could be. As you think about takeaways from this standard, I want to encourage everyone to think about this early on, right? Not when the auditors come out to actually do field work, but especially if you are a 12/31 or if you're an upcoming June 30th year end, think about the fact that you're not necessarily going to have all of the required information available through the general ledger or through your traditional financial reporting software. You're going to need information from HR on benefits. You're going to need information maybe out of your payroll system, wherever your leave banks exist. And then think about what kind of help you might need, right? So if you're struggling with the application of this standard conceptually, reach out to us, reach out to your business advisor. We want to help start thinking about this in advance because that calculation is going to affect your financial statements. And if you start trying to do it during audit fieldwork, it's going to take away from your time and effort and energy spent doing other things. So thinking early will help you to implement this standard well and carefully and avoid any delays in the process. So that's GASB 101. Let's talk about the next upcoming GASB standard, GASB 102, certain risk disclosures. This standard will be effective first for periods ending June 30th, 2025. So if December 31st year ends get a GASB 101 first, June 30th year ends will get GASB 102 first. The GASB felt that it was time for further discussion of risk disclosures because they felt that there was inconsistency between the FASB subtopic on risks and uncertainties and what GASB reporting entities were doing. And also, I think the pandemic was a big driver for this too, with organizations not knowing exactly what to disclose, but knowing that there was a huge impact on their operations, their funding, so on and so forth from COVID-19. They felt that maybe if they developed a risk framework, something like that in the future could be properly reported and accounted for consistently. They said they were going to address a couple of things: categories of risk and uncertainties, what the disclosure requirements within each category are, and the criteria associated with those disclosures. So for this standard, we primarily need two main discussion points. We're going to talk about concentrations, definitions of concentrations, and definitions of constraints. So a concentration is a lack of diversity related to an aspect of a significant inflow or outflow of resources. So basically too much in one pot, right? And that could be employers, industries, inflows of resources, revenue, workforces covered by bargaining agreements, providers of financial resources, supply chains. We saw during the pandemic huge disruptions in supply chains. So anytime you've got too much in one bucket, you're exposed to a risk that if something happens to that one bucket, it affects your organization widely as a whole. Second, we need a definition for constraint, because both these terms are used substantially throughout the standard. Constraint is a limitation imposed by either an external party or by formal action of the highest level of decision-making authority, i.e. the board, right? Board of Education, Board of Commissioners, Board of Directors, etc. That might be a limit on raising revenue, a limit on spending, limiting incurrence of debt, or mandating spending. So as you're thinking about these definitions, you might go, well, Dan, every organization is going to have concentrations and constraints, and you're exactly right. Every organization will have concentrations or constraints that you could identify right now. But luckily for us in the standard, they tell us that it has to have substantial impact, which is greater than significant or material, and it's something that involves a fair bit of professional judgment. But at the very least, we know substantial impact means it's big. It's more than material. So just because you happen to have concentrations or constraints, everyone does, doesn't mean you have something to disclose. We're going to disclose it when it has a substantial impact. What type of framework might we use to try to make sure that we are thinking correctly about concentrations or constraints? Well, I think there are sort of 4 bullets on these next 2 slides that help us to think about that framework well. So if that concentration or constraint poses a risk that the government might not be able to raise resources or control spending in fashion that might prevent that government or that organization from providing services at the level that they currently have been provided, or meet obligations as they come due, that's the point at which we start to think about that substantial impact. So just to go back, you're struggling to raise resources or you're struggling to control spending in a way that is going to make it hard for you to keep providing services or meet obligations. Those are some real key factors for us in thinking about, is this something that might need to be disclosed? Again, professional judgment, thinking about this at the level of substantial impact, not just is it something that we have. So let's briefly walk through these disclosure criteria in order here. First, if you're going to have something to disclose, that concentration or constraint has to be known to the government prior to the issuance of the financial statements. So it's not something we think is going to happen. It's something we know is happening prior to issuance. And then that's not the financial statement date. If you're a June 30th financial year end, that's not June 30th. It's when the financial statements get issued for that June 30th audit. Second, it has to have substantial impact, big. It has to be very big. It has to have an impact on the whole reporting unit and make that unit vulnerable to the risk of substantial impact. Third, and maybe finally, the event or events associated with that concentration or constraint that could cause a substantial impact have to occur, begun to occur, or we think they're more likely than not to occur within 12 months of the date financial statements are issued. What that means is this could be something that happened during the year. This could be something that happened right after year end, or something that we think is more likely than not to happen within 12 months of the date those financials are issued. Not year end date, but date the financials are issued. The GASB says we also get to consider if mitigating actions have been taken by the government prior to the issuance of the financial statement. So let's give an example of this. Let's say we have a collective bargaining agreement that covers all of our employees. And that collective bargaining agreement is set to expire for our June 30th year end in September. The financials get issued in November. we think that bargaining unit is going to expire. We know it's going to expire because it's dated ending in September. But we have come to an agreement with our employees that they will continue to operate under that bargaining agreement for an interim period of 1 year while we hash out a new multi-year bargaining agreement. To me, that would represent a mitigating action, right? So it's a concentration or constraint, yes. If all the employees walked out, it would be a substantial impact, yes. But they've agreed to continue to work under that agreement for another year, meaning that there's really not a substantial impact to us in the next year, as long as they continue to work under that interim agreement while we hash a new one out. So in that case, nothing needs to be disclosed. Who needs to disclose? The primary government needs to disclose any potential risks under this standard, and individual reporting units that happen to have revenue-backed debt. So revenue-backed debt, of course, there has to be a revenue stream to fund the debt payments. If that revenue stream is affected by a specific risk criteria, a concentration or constraint, that could have a substantial impact on that reporting unit's ability to continue to make payments on that revenue-backed debt. So they would also need to disclose. For each concentration or constraint that meets the criteria, there needs to be certain information provided. You have to disclose the nature of the circumstances disclosed, the vulnerability to the risk of a substantial impact. You also need to include descriptions of the concentration or constraint, each associated event, whether it's begun to occur prior to the issuance of the financials, and any mitigating actions taken prior to issuance. So trying to describe what that disclosure might actually look like if we find ourselves in a situation where we have a substantial risk disclosure. Finally, we can't disclose. So if we come up with a note disclosure, we cannot disclose things that have not yet begun to occur. So if the board makes a plan to do something, we can't say in that financial statement footnote, there's a plan. You can put it in your newsletter. You can tell your constituents about it. You can't put it in the footnote until you've actually done something prior to issuance of the financial statements as a mitigating action. So just a couple of takeaways on GASB 102. First, don't panic. There's a disclosure framework. I know it's very judgment-based, right? But there is a framework for us to figure this out. Talk to your auditors. Consider these things carefully, especially around the time when you're identifying other subsequent events. Be considering with your business advisor, is there anything that we think maybe could have substantial impact? Bargaining agreements, new tax rates, adjustments to tax millages that didn't get approved, things like that. We try to have our minds focused on substantial risks as well as subsequent events, especially during fieldwork and audit wrap-up phases. GASB 103 is the new financial reporting model improvement standard. Now, this standard is going to be first effective for periods ending June 30th, 2026 and after. So we've got a little bit of time to think about implementation. Why is the GASB putting out a new standard on financial reporting model improvement? Well, it's been about 25 years, and the GASB has a significant focus on trying to review existing standards. They call it post-implementation review, and make sure that they're operating in the way that makes sense, and that if there need to be improvements, that they're identified and put into place. So GASB 103 is the first time since Statement 34 that the GASB has sort of holistically reviewed the reporting model for governmental financial statements. Maybe the most important things to note about changes made under the standard are the changes that didn't get made. The GASB did consider changing the measurement focus and the accrual basis of accounting for governmental funds. A couple of different things were considered as part of their iterative process, but ultimately, neither of these changes were made. So we're going to retain our current financial resources focus. We're going to retain our modified accrual basis of accounting. So those of us who have been doing governmental accounting for a number of years, very happy about this because it means we get to continue doing the things that we've been doing. We're not going to have like a radical or massive change to how we present modified accrual governmental funds. One other thing that was considered was changing the presentation of governmental fund financial statements. There are no changes to the presentation of governmental funds under GASB 103 either. So no changes in measurement focus, no changes in the basis of accrual, and no change in the presentation, which is great. Additionally, they didn't change any of the concept statements related to either measurement, focus, or basis of accounting. The GASB is very good about telling us what they're thinking. That's what they're doing with these concept statements is giving us the underpinning of their judgment around what they think they should be changing in GASB standards and why they're doing it. They didn't change any of the GASB concept statements related to these standards. So what things were affected? Well, we're going to talk about most of these here today, but the contents of MD&A were affected. We're going to get a new definition for unusual or infrequent items that replaces our previous definition of extraordinary and special items. We're going to have a new presentation for proprietary fund financial statements and some new definitions within proprietary fund financial statements. There are also some discussion of presentation for major component units. There's new ways that they want us to present budgetary comparison information. And finally, they're going to give us a couple of simple rules on the statistical section in the Act to make sure that it lines up with their new rules on proprietary fund statements. So now the MD&A is going to consist of 5 sections. And don't worry, I'm going to compare and contrast this using the table that GFOA gave us to what it looked like previously. But the new MD&A is going to be limited to 5 sections. You're going to have an overview of the financial statements, financial summary, a detailed analysis, a section for talking about significant capital asset and long-term financing activity, and also we'll have a section called currently known facts, decisions, or conditions. Now, in the standard, the GASB wants to give particular emphasis to the why. They emphasize this several times in the standard, and they sort of go, we really don't want you to be telling the user about the what in the MD&A. We can see it went up and down. We can see that revenue went up, and we don't want you to tell us, well, we sold more widgets, revenue went up. We want to give you to give us the underpinning. So let's say license and permit revenue goes up. We don't want you to say we sold more dog park licenses. We want you to tell us we opened a new dog park, and that's why dog park license sales improved, and that's why revenue went up. So we really want to get at the underlying economic substance of the why. They also want us to avoid unnecessary repetition. In GASB 103, the GASB tells us if you're going to say the same thing twice throughout the financial statements, what we'd like you to do is just to say it once and then make reference back to where you said it the first time, as opposed to saying it over and over again. This is one of the ways in which the GASB is hoping to reduce the size, the volume, the length of governmental financial statements, which, as we all know, can get out to 200 or 300 pages. So the final sort of key element that they're adding to MD&A is that they want more discussion of significant policy changes. So that might include such a thing as a change in tax rate, new fees, imposition of a hiring freeze. If you have an important change to your economic factors, like the employment base changes radically, they might want you to discuss that also in MD&A. So here the GASB gives us an example of a figure that they might include in their overview of the financial statements, something that might help users understand, okay, look, internal service funds might fall under governmental activities at the government-wide level, but they're included in the proprietary fund financial statements at the actual fund level. They include several examples like this in the actual standard, hoping to, I think, encourage preparers of financial statements towards probably about 2 things. One is they like charts and graphs, and I think it's a helpful way to display information for users in an understandable fashion. And 2, they want to help users to understand the flow of financial statements and financial statement data so that it isn't quite as confusing for someone who doesn't have years of experience in preparing and reading governmental financials. As promised, here's a brief table comparing the current required components of MD&A to the required components under GASB 103. So under GASB 103, you can see we are kind of condensing 6 elements into 5 elements. And then we're going to move our analysis of budgetary variations to the very end and eliminate altogether the requirement to discuss infrastructure accounting in either the MD&A or the RSI. So we talked about the sort of 5 required elements of MD&A. I'd say the only other thing I would bring up is that in the bullet point 4 under GASB 103, significant capital asset and long-term financing activity, they do want preparers of financial statements to address leases and subscription activity in that section, as well as other types of assets and financing activity. So that is an explicit discussion in GASB 103. We'll talk about RSI here and budgetary variations in a moment. Up next, unusual or infrequent items. Now, this isn't a massive change. It's a new classification that pretty much one-for-one replaces our previous definitions of extraordinary and special items. Now, if you remember, previously, extraordinary and special items were given the following definitions. They had to be unusual in nature, so abnormal or significantly different, or they had to be infrequent in occurrence, so not reasonably expected to recur in the foreseeable future. No change to this definition under GASB 103. This is still what we're going to use to define our unusual or infrequent items. We're just going to call them something different. The change that we will see is that there is now a different presentational change. You've got to break these out as the last flow items before the change in net position of the change in fund balance. And we should be reporting these as gross, so not netted together into one line where we see unusual and frequent items all as one thing. No, we should show our inflows and our outflows. So we'll see an example of what that looks like in just a minute. It's going to look something like we get inflows from a grant recovery, and we have outflow as the actual cost of repairing the damage from a natural disaster. So we'll see an example of that in a second. Maybe one of the larger changes under GASB 103 is the change to proprietary fund presentation. Under this change, they're going to give us a new definitions of operating and non-operating revenues and expenses, so new definitions of the flows for the statement, a new definition of something called a subsidy, and a new format that we're going to look at for how to present the statement of net position for the proprietary funds. So non-operating revenues and expenses, these are going to be, we'll talk about in a second, new subsidies, contributions to permanent and term endowments, revenues and expenses related to financing, investment income and expenses, and resources from the disposal of capital asset activity and inventory. So under GASB 103, if you're saying what is a non-operating revenue or expense, it's one of these 5 things. If it's not one of these 5 things, it is specifically operating revenue or expense. So we now have sort of a new bright line in between what is operating, what is not operating. Non-operating is something that meets one of these 5 definitions. Operating is everything else. So we said there's a new definition even within non-operating. What is that definition? It's a subsidy. It's resources that are received from another party or fund for which the fund does not provide goods or services to that other party or fund, and that directly or indirectly keep the current charges and fees of that fund lower than they otherwise would be. So what are they doing? They're subsidizing that fund. So this is our definition of subsidies as an inflow. It also could be an outflow to another party or fund for which the recipient is not providing goods or services, or that are recoverable through the proprietary fund's current or future pricing policies. So this kind of scopes in all other transfers as well. And the standard things that the GASB thinks we're going to see as subsidies are transfers in, transfers out, insurance reimbursements, intergovernmental revenue, right? Things that might be subsidizing from other funds, other sources, pushing down the rates, right? So if I have a rubbish fund and that rubbish is 75% funded by charges for services from users, I get billed every month in the city that I live in for rubbish collection. And then 25% of that is either intergovernmental revenue from the state, or more likely it's 25% is a transfer in from the general fund. That transfer in or that intergovernmental revenue is a subsidy for that fund, because that's 25% of the fund that I am not paying for as a user through charges for services. We're holding down rates by bringing in money from somewhere else. It's from the general fund, it's probably from property taxes, that type of thing. So here's our first example, Exhibit 8 from GASB 103. Where we see this is what a non-capital subsidy section would look like. And you see that we have exactly what the GASB expects. We have some intergovernmental revenue, that's all over in the Internal Service Fund. We have some transfers in, we have some transfers out. You can see that for both the Transit Authority and the golf course, we have subsidy transfers coming from other funds or sources that are subsidizing the operations of those units. So this is what a subsidy disclosure section might look like. You can see it comes after the operating section for a proprietary fund statement. Here's an example from GFOA where they've taken us one step farther, and we're going to kind of wrap in our discussion of unusual or infrequent items here. So in this example, you can see we assume that on the previous page, we broke out all of our flows for operating expenses and operating revenues. And we start here with subsidies. So we get our net operating income or loss, and then we show subsidies. Again, intergovernmental revenue transfers in. Then we have our next section, which is our other non-operating section. So we've got investment income, capital contributions, interest expense. These are all other non-operating revenues or expenses. And then finally down here, we can see this new presentation from unusual or infrequent items that would apply to either this proprietary fund statement or a governmental fund statement, where you're showing us the gross inflows and gross outflows for dealing with this unusual or infrequent item, which in this case is considered to be an earthquake, an adverse weather event, something like that. These would all be unusual or infrequent items. And you can see that the net cost to the government or to this fund for the year in question is 35 million or $1,000. I can't remember what the scale of this fund report is, but you're showing those grant revenues as a separate inflow and the response and cleanup as a separate outflow, which is what the requirement is. So handy example for us to look at and go, great, we know what the ordering should be for subsidies, for other non-operating, and for our unusual or infrequent items. Now, back at the beginning, I mentioned that there are some changes to major component unit presentation. The rules for major component unit presentation really haven't changed overall. They should be as a separate column in the statement of net position. Each discretely presented component unit, they say separated out unless it reduces readability. And for most large governments, it does to separate a number of component units. So they present them all in one column, and then they present a combining statement following the fund financial statements. Now, if you were previously doing this as a note disclosure, this is really the essence of the change here. If you were previously unwrapping those discretely presented component units as a note disclosure, you can't do that anymore. It has to be in an actual statement following the fund financial statements. Budgetary comparison information, we're all used to seeing this if you've been doing governmental financial statements for a little while in the MD&A. So previously, often you would see discussion of budgetary statements in the MD&A, and then you would either see budgetary comparison schedules in the actual audited statements, or you'd see them in RSI. Well, now the GASB is basically saying these are now RSI. So everyone's going to be changing their presentation. If they weren't already presenting their budget to actual statements in RSI, that's how it will be moving forward. There won't be any change to supplementary budgetary comparison information, which is if you were presenting more than was required for the base requirement being general fund and major special revenue funds. If you're presenting all special revenue funds for ACFR presentation, if you have other funds with a legally adopted budget, those are going to continue to stay in supplementary information. We're also going to add the requirement that there will be original and final budget variance presented, and I'll show visually what that might look like as well. So not only are you going to have to continue to explain, and there's always been the recommendation you should be explaining differences between original and final budget, but now we're going to have to show the variance between original and final budget and explain that in the notes to the RSI. So here's what that might look like. This is our new column. You can see I've called it out in the middle here. This basically looks like a previous budget to actual statement, just with one new added column. So you've got original budget, amended final budget, and then you have to show the difference or the change between original and amended. So you have to show explicitly what your budget amendments were between the original and the final version approved at the end of the year. Then, of course, you've still got actual, and you've still got a variance between final budget and actual amounts to present. And then once you've presented those schedules in the RSI section, you now need to be explaining the differences between your original final budget and your amended budget and actual. And the GASB would love it if you did this in a tabular format. So they've showed you a tabular format here. Remember, I said they liked figures and tables earlier. They also like a good tabular format. Now, they say specifically, you can do this explanation in sentence or paragraph form if you'd like, but they think it's a great idea for the user to be able to go basically trace one-to-one, right? So in this format, if you are looking at the over-under for one specific line, you can trace the number, the change from this notes the RSI back to the actual RSI schedule. Finally, the GASB tells us that there should be some changes for statistical information for financial trends presented, especially for those governments engaged in only business type activities or only business type and fiduciary activities. They basically want the stat sections to mirror the requirements for proprietary funds, distinguishing revenue by major source and distinguishing between operating, non-capital subsidy, and other non-operating revenue and expenses. One last technical item to discuss. GASB 103, the GASB says should be implemented in the same year as by the government and all component units. That often isn't the case, isn't a problem if your component units are all being audited at the same time and presented in the same financial statement. But there are certain occasions where you have a separate financial statement and a separate audit being done for a component unit whose fiscal year end is earlier than the primary government's fiscal year end. And in that case, as a primary government, you're going to need to communicate with your component unit and make sure that the standard is implemented at the same time. So an important thing to take away. So just a brief summary at the very end here. What is GASB 103? What should I be thinking about? It's something that will change the structure of your financial statements, and it's going to take some significant time from a preparer perspective. Even if you are not the financial statement preparer, having detailed conversations as part of planning with your financial statement preparers is something that will help you to be in alignment about how the changes of the standard are going to affect your financials, how they're going to be implemented, and it affects how the board's going to look at them. If your board's used to going to a certain page and finding the general fund budget to actual, they might have a new section that they need to look for. Additionally, if you are management who is relying on a third-party firm to prepare your financial statements, you're going to have to give feedback not just on MD&A, but also on the notes to the RSI sections, because you're going to have to do your budget to actual explanations in that area. Additionally, if you present a number of proprietary funds, you do need to be sure that your preparer has enough information to properly present the flows, both the inflows and the outflows, in accordance with the new changes to proprietary fund disclosures. So you need to be sure that you've got enough information that you're giving them in the trial balance to properly classify line items in the proprietary fund statements. And with that, that's GASB 103.
I'll be talking about the energy credits and kind of really focusing on what are the eligible entities, the benefits of these credits, and kind of the requirements for claiming them. So let's first talk about what the elective pay option is, or also maybe you've heard of it mentioned as direct pay. This provision allows eligible entities to receive receive a payment equal to the full value of the tax credit rather than using them to offset tax liability. So in other words, you get cash for this instead of a tax credit to offset tax liability if you're a for-profit industry or a company. So this can be, particularly beneficial for eligible entities that do not typically have tax liability to offset. And what I think is really interesting about kind of these new provisions that allow us to take advantage of this, where historically maybe we wouldn't have under a tax bill, is this is applicable starting in 2023, and it currently goes through December 31st, 2032. So we've got kind of a 10-year time period where this current, benefit is applicable to us. So let's talk about kind of who qualifies. Eligible entities can include kind of a wide range of organizations. So it can be tax-exempt organizations like religious institutions, colleges, hospitals. It also includes state and local governments, including school districts, Indian tribal governments, Alaska Native corporations, and additionally kind of public power entities like municipal electric utilities, rural electric cooperatives can also take advantage of these credits. So pretty wide spectrum as far as who may be eligible to take advantage of this. So then we think about, okay, well, what sort of energy properties may qualify? So eligible energy properties can include solar, wind, geothermal, energy storage technologies, just to kind of even name just a few. Additionally, there are energy credits related to investments in charging stations or qualified commercial vehicles. So when you think about, all right, what is this benefit, right? The base investment is the base investment tax credit, or the ITC, is 30% for projects under 1 megawatt. For projects over 1 megawatt or larger, the base is 6% of your investment, unless the project meets a prevailing wage and apprenticeship requirement, which can then bring it to 30%. So pretty advantageous when you think about kind of an initial cash flow of, all right, we're going to invest this amount. We're automatically kind of going to get, 30% or 6%, or if you don't meet the prevailing wage and it's over 1 megawatt, initially back, in addition to the other benefits of installing an alternative energy project. There are also bonus credits available for projects that meet certain criteria. So there's one for domestic content where you'd receive an additional 10%. Similarly, projects located in an energy community or what's called a brownfield site can also qualify for a 10% bonus. And then projects in low-income communities or Indian tribal lands can receive an additional 10 or even 20%. So these, bonuses can definitely significantly enhance the financial viability of clean energy projects. We think about kind of, all right, how is this going to work mechanically, right? So here's an illustration. So let's say, imagine we are a local government and we invest in a 500 kilowatt solar energy system that is designated energy community and ensures that the project meets the domestic content requirements. So let's say the price is $1 million. So under the ITC, the base credit would automatically entitle us to the 30%. So that's $300,000 in direct pay we'd be eligible for. That's because, again, right, it's under 1 megawatt, so we don't have any additional criteria we need to meet. Then, because the project also qualifies for some of the bonus credits, you get an additional 10% for meeting the domestic content requirement, and then an additional 10% for being located in an energy community. So when we think about what is the total benefit we are eligible for, it's $500,000 or half the price of our initial investment that you immediately get back. That's not including kind of the advantage of being able to say, hey, you are, energy efficient, or you are saving on your utility bills, that are also cost savings measures as well. So I think this, again, highlights the significant financial benefits of claiming an energy credit. So by leveraging the elective pay, it can help reduce upfront costs, making them much more financially viable when we're thinking about, all right, what is this cost we may have to incur to install this? So that way it allows us to kind of reinvest in critical infrastructure, upgrades, or community programs. So beyond kind of the financial benefits, claiming these credits can support kind of broader clean energy goals. So by transitioning to renewable energy sources, again, we can talk about energy costs over time being lowered, carbon emissions, contributions to a more sustainable future. So all those other additional things that you'd be, additional advantages that you could take. So I think one thing that's important to emphasize here is that these credits do require some detailed documentation. So a lot of times, right, it may be more formulaic as far as, what percentages we're entitled to based on kilowatts and the type of investment. We do want to emphasize there is a large documentation requirement. So if you're over 1 megawatt, there is some criteria around how much information you need to provide to, meet the prevailing wage requirement, for example, or meeting the domestic content. So there's been final regulations on domestic content, which were recently issued. They kind of underscore the need for thorough record keeping. So, for example, entities that demonstrate that a specified percentage of the project components were manufactured in the United States, which will require detailed procurement records from the manufacturers and supplier certifications for the domestic content eligibility, for example. The last thing I want to touch on is the filing requirements. So, one critical aspect of claiming the elective pay is understanding the filing requirements, especially for entities, right, that maybe traditionally are not filing a tax return. So, for example, tax-exempt organizations such as a religious institution or a college or a hospital generally are not going to file an income tax return. However, to claim one of these elective pay options, the organization must file what's called a Form 990T, the exempt organization business income tax return. So even if you don't have any unrelated business income, taxable income. So this process may be unfamiliar to many of you, but it is important to prepare in advance. So what is the viability of this kind of still being relevant with the new administration? So I think there's been a lot of discussion as far as, right, we talked about initially, there's this 10-year window right now as it currently stands. But with the new administration, there's, talks about, all right, how are we going to kind of look at alternative energy that was a priority under the earlier administration, or the Biden administration? How may that look under Trump? So right now, it's our understanding that the administration may target specific provisions for reduction. However, it's unlikely that they'll repeal incentives for investments in eligible energy properties that we discussed today. So that being said, I think by investing in eligible energy projects, you can lock in those benefits and be fairly secure that, right, these are things that'll stay. So kind of in summary, elective pay energy credits offer a unique opportunity to advance clean energy initiatives while driving significant cost savings.
Let's talk about some upcoming possibilities for continuing education. You see that you're right here sitting through the end of our Governmental GAAP update. That's our first presentation for this year. We've got a number of other things available, starting as soon as tomorrow. If you have interest or involvement in a not-for-profit, you might want to sit through our not-for-profit update. It's a panel presentation, and it's going to dive deeply into 2025's accounting pronouncements related to not-for-profits. In April, several of our wonderful HR consulting people are going to be presenting on effective succession planning for public sector. Come back in July, and we'll be talking about the single audit updates and the updates to uniform guidance as we continue to flesh out the impact of the new uniform guidance changes on single audits. And finally, in October, there'll be another panel presentation on key strategies to improve your organization's internal controls. So these are all free, all available externally. You can sign up through our website. We'd love to have you participate in one of those. With that, I'm going to turn it back over to Darren to take us out in style.
This concludes today's program. Thank you for joining us. With respect to people's time, we will be reaching out directly to answer all the questions submitted. If you would like to learn more, please visit Raymond's website at www.raymond.com. You can also email us at publicsector@raymond.com. Thank you and have a great rest of the day.